Joining us now is David Katz, Chief Investment Officer at Matrix Asset Advisors, a man who was bullish to begin the year, and right, I should say. But you see these gains that we've just had. And by the way, those are just a few stocks that we plucked out. It's been a big run for a lot of names. Are the markets, have they gotten ahead of themselves?
Well, they've gotten ahead of themselves. We started the year very bullish. We continue to be bullish. We think the market ends higher than it is now, but it's not going to be a straight line. So you don't want to look at the rally over the last 6 or 7 weeks and say, oh boy, stocks are going up, let's jump in right now. We'd say if you have money in, you can stay with it, but you want to look to buy on the dips.
So don't allocate new money now.
We would not. If you're over allocated to stocks, if you were worried in December that you had too much in stocks and all of a sudden you've seen this nice 10 or 15% rally, use this as a time to take a little bit off the table. We think there are going to be more bumps along the road. Trade is the significant issue right now. We're hopeful that there's a deal, but there are probably going to be some scares along the way. If there is a deal, that will make our bullishness that much more confident that the year progresses very nicely.
Because, David, I am willing to bet, I'm going to look at our audience, because there are many of you out there, some you know you're watching right now, I see you, that sold in December. You know, they sold into the weakness. We know that because stocks go down when more people want to sell than want to buy. And maybe they didn't time it. They didn't jump right back in January. Now they're looking and they're watching this and going, wow, look at these gains. I need to get back in. You're saying wait for some kind of a pullback.
Don't do it. Understand your psychology that you sell into weakness. You don't want to do that. You don't want to chase the rallies. Wait for a pullback, and then when the pullback happens, remember how you felt today that you're missing it, and then start to buy into that.
But that doesn't mean all stocks are overvalued.
Exactly. We think the market actually is about modestly undervalued. It's about 15.5 times this year's earnings, and that's pretty reasonable.
The S&P 500.
The S&P 500 in a low interest rate, low inflation environment. So we think stocks are reasonably priced, but you just did have a 15% run. It's going to slow down at some point, but we do think the year can move higher after that.
Okay, but not all stocks are created equal.
That's correct. So
AT&T, you believe, is still a good value. Why?
Well, AT&T sells at under 10 times earnings, pays about a 6.6% dividend. So the stock is up a little bit this year, but hasn't nearly moved enough with the market. We think it's easily a $35 to $37 stock, and you're getting paid this great yield while you wait.
Man, they made a big deal, though. I mean, they spent a lot of money on a merger. You know, DirecTV is not working out maybe the way they wanted to.
DirecTV has been a failure. However, when they bought the Time Warner, they bought it before the tax cut, so they really paid a really good price for that business. So we think the stock is at a great price. We think that their balance sheet is okay. They're going to pay down a lot of debt this year, and they can support the dividend, and the stock is not acting like any of those good things can happen.
I know the name is Alphabet. It's still hard not to call it Google. Whatever you call it, G-O-O-G-L, you believe also is a good value. Make the case for Alphabet.
So Google's revenues were great. They spent a little bit more this last quarter because the revenues were so good. They had an earnings beat, but people were concerned about the expenses. We think as long as the revenues are coming in this way and you're paying it about 17 times earnings if you adjust for cash flow, if you adjust for cash balances, that's a great price for a great business. They have not rallied nearly as much as the market has this year. We think there's going to be some catch-up.
From a consumer side, Wells Fargo is doing a full-court press to win back some of the trust of people after some of their scandals, like the fake checking accounts and all this other stuff. You know, you see the ads basically like, this is the new Wells Fargo. You think it's still a good stock, maybe a new Wells Fargo from an investment perspective as well?
From an investment perspective, we think this is going to be a very good year for them. And they've rightly been in the penalty box for some horrible actions for the last 2 years. We think that's going to get better, and by year end, they're going to be able to see the light at the end of the tunnel. And we think the stock starts to react to that now, pays a very good yield, low PE, and we think they have one of the best footprints in the country, and we think they are getting their act together.
All right, Wells Fargo, AT&T, Google, but overall, don't chase this market. David Katz of Matrix, we appreciate it, David. We'll see you soon. Thank you.